Hey traders, Day Trader Matt here of businesswithtrading.com, and today I want to talk about gold futures and a trade that we took prior to FOMC, and I want to talk about the reasoning for it and why it was such a good trade. And we're still in a little bit of it, but let's get into the actual what we were looking at. So if you've been watching me for any amount of time at all, you know that I was looking for the market to come lower. As it was up here, we were talking about looking for it to go lower, looking for it to have a nice short, and we were able to, take some trades on the downside. Had a trade in the options group as well, swing trades to the downside, day trades to the downside. It was just really good. You even got a little upside trade if you wanted. So it was really nice. So we were looking for the market to break down, and usually when there is more volatility coming into the market, we were looking for the VIX to go higher. Usually gold's going to go higher too, especially when there's uncertainty. So what we were watching, and this is an hourly chart right now of gold futures April contract. We were trading April because we were just looking for a quick pop. It's not a trade that is it going to be long term? That's not what I'm seeing right now. It could potentially turn into a long term, a long, and just be crazy. That's not what I'm seeing, and that's not what we were looking for to take the trade. We're looking for a nice quick pop. This obviously was the first level of resistance, and then these areas are the next levels of resistance. So let's pop down to a 5-minute chart, and that's how we actually got this trade, and that's how we started looking at it. Whenever the market came down here, this is 10:20-ish, 10:15, 10:20, and the market did come back up. As price came up, that's when we decided, okay, we want to look for a long. Where are we going to look at? And we drew these two areas here. This is, an ultimate low we were looking for. Price obviously came down a little more, but it did pop above it. And that is considered holding support. Some people want it to stay above it or hit it to the T and then go up. Me, it doesn't matter to me. It either stays below it or it gets right back above it. If it were to chop around for a few hours, up and down, that's just hideous chop, and that's not anything I would want to trade. But because it pops right back up, it did hold this support. It looked pretty good, and as it got up here, we started looking where can we get long at and keep our risk relatively tight. So we drew this, and we decided, okay, well, if we got long at 1309, that would look pretty good. But because these lines were like it is, we got long at 1309 right here, 1309.30. We were able to have our stop down here at 1307.30, giving us a 2-point stop. Gold is 100 points per contract, per point, $100 per point per contract. So we're looking at a $200 risk right here, which was phenomenal. If we get stopped out, who cares? It's a $200 loss, per contract. But we're not putting on 5,000 contracts. I'm not balling out of control like that. But we can put on fairly decent size. So what we're looking for is that nice fast pop. And like I said, we were looking for 1345 initially, and then above there, anything that we can get. So basically what we did, we got long right here. This was the 20th, and FOMC was right here Wednesday at 2 p.m. And anyway, what we did is we got long, and then we just set our stop and waited. And price did chop around a little bit, overnight, just looking haphazard. But then it started to take off. And once it took this high out, it was actually looking pretty good. You can see it came down again, and then it took off again. And you had a larger retrace, and then it took off again. And it started looking really, really good. And that's really the whole point of trading anyway, is to be able to make a little money and make some profit. Okay guys, so let's talk about this trade a little bit more. So we saw this pop up. Okay, so it spent, this is a 5-minute chart, so it spent relatively 9-11 minutes below this support line ish, I'm estimating here, and then it popped right back above. And like I was saying, I see that as really holding the line. This, for example, it got down here, and these two lines weren't drawn until after price was up here, so don't really pay attention. But as an example, price did get below this. It tried to get up, it couldn't. It chopped sideways. When it did get up, it sold off again. That's choppy crap, but it does look like price is going to go lower. Obviously hindsight's always 20/20, but this is something I would not have traded at all. I would have looked at that and said, well, that's just hideous. Possibly you could have looked for something on the short side. I most likely would not have. It really depends on the context to the left side that we can't see, but most likely I would have not done anything at all here. That just looks ugly. This is a large selling candle. It is what it is. But then when price did pop up, it moved up nice, and then that's when, okay, let's start looking for a long trade, see what we can actually do. Obviously we put in our price right up here, so that way we could have our stop down here, because if price did come all the way down here and stop us out, obviously something else is playing out. And could we have our stop up a little higher? We could have gone at 1308. I would have been comfortable with that. 1308.30, it's kind of pushing it, but I probably still could have been comfortable there. The reason I put it down was because we were going to go into FOMC. It was going to be choppy. If it hit 1307.30, it definitely was doing something different. If it hit 1308.30, it possibly could still go higher, but because of the volatility, it was possible. So that's why we put our stop lower. And that's really why I talk about being knowledgeable of what economic numbers are coming out, what's happening. Some of them are a little more predictable, some of them are not. This isn't about predicting the actual outcome, like how much are they going to raise interest rates, or are they going to lower them, all that junk. I don't pay attention to any of that. It's how is the market likely to react. Well, it's going to be volatile because FOMC day is always volatile. One of my favorite things to do is play currencies on FOMC day because they're usually pretty volatile. My favorite pair in Forex is Singapore yen. I love it. New Zealand yen and Australian dollar yen, because those pairs are highly, highly volatile. I don't recommend trading those unless you're very experienced, because they're very volatile. They can move 200 pips at 300, 400, 500 pips a day. The pound yen is another one. But anyway, I don't want to get off topic, but those are volatile. Obviously I talked about where we're looking for the market to go in this scenario, where we're looking for the VIX to go, and gold is a good precursor to that. Obviously, correlations change, the market's dynamics are going to change, but that's really what we were looking for. Okay, so now that we have spoken about that, let's see if I can zoom out if it doesn't look totally hideous. Okay, that doesn't look too bad. So let me get out my pen, and this is where we got long at. Over here. So we had basically $200 of risk I'll just put an R there, $200 of risk, and we took our first profit at 13.41. So it would have been right here, first profit. And why did we do that? Because this was our first resistance level. And because of that, we could see, or I could see anyway, the market coming up and then selling off. That's possible because it's resistance. In hindsight, obviously it's 2020, the market has pushed above. It hasn't shown its hand yet. Is it going to get much stronger and go above this second resistance and then the third resistance? Is it going to do that? Is it not going to do that? I don't know. It's always good to be able to take profits when they present themselves, and that's basically what we did. We took profit when it presented itself. So we took first profit right here at 13.41, which equates to 31.7 points, or $3,170 per contract. So that was actually pretty cool. That's good profit. And then we were able to move our stop up right here to 13.33 is our stop. And that would equate, if we did get stopped out, to $2,370 per contract. You know, so being able to move our stop up here was actually pretty nice. And that stop, I believe, if it does keep going above the resistances, I think our stop is very safe. If it does turn around, then we're likely to get stopped out. Either or, that's a fantastic trade. So when we're looking for the actual risk reward, if you only took one contract, you got in and then you got out at 31.70, that would be a 15.85 reward to risk. If I could draw an R. If you took two contracts and you took profit here and then you moved your stop up here, then you would be at 13.85 reward to risk. So you see that your reward goes down a little bit, but you know, your profit is lower here than it was here. And it's not about who can have the highest reward to risk. It's about who can have a consistent over 3-to-1 reward to risk. Because if you're consistently over 3-to-1, it's really hard to blow up an account. It's very, very difficult. You know, if you have the proper trade size, you have the proper, reward to risk, you're going to do okay, and you're going to be consistent. And that's really the key to trading, is being consistent. So hopefully you enjoyed this video. You did get something out of it. I try to talk about reward to risk just because it is very, very important. And obviously I go into much detail in courses and mentoring and stuff like that. But hopefully this video, you did get something out of it. You learned something. That's really the whole point of me doing these videos. What I did take into account if you traded two contracts was double this. I didn't mention that. If you did take two contracts, obviously you're risking $400 rather than $200. So I did take that into account, and that because this profit is a little bit lower. That may be a question that one of you guys had. My bad, I didn't mention that, but now I am. So hopefully you did get something out of today's video. Feel free to comment below if you like the channel, enjoy it. You can share or hit the like button, something like that. That would help me out. Appreciate that. Have a great rest of your day. Enjoy the market, or the rest of the market, and I will see you back here in the markets. Bye for now.